Let's examine the Chinese market today, which has the biggest impact on the current economic picture. The Chinese market has been expanding astonishingly quickly, with strong economic growth each year. There were numerous investors during this period of prosperity, and many stock prices increased, providing investors with excellent returns. China has been unable to display its former brilliance for the past 1 to 2 years as a result of its erroneous policies in response to the pandemic. See if China, which recently made the right choice by relaxing the containment policy, can produce the same GDP growth. First, consider China's recent economic status. 1. Real economy. China's economy has recently worsened amid the resurgence of COVID-19 throughout a large area as downward pressure on the economy, such as the deterioration of the real estate market and declining exports, has persisted. Industrial production decreased significantly, 9.6% in 21, 3.8% from 22.1 to November due to a decline in manufacturing and electricity/gas/water supply. Fixed investment, manufacturing investment and SOC investment performed well. However, real estate development investment displayed a significant margin. Has diminished retail sales, restaurant sales, down 5.4% to 18.6%. And merchandise sales also declined. Exports, as a result of COVID-19 quarantine measures, production and logistics delays persisted, and external demand weakened, the rate of growth decreased. Imports, 30.0%, 2.0%, also went up as a result of base impact and weak domestic demand. Has drastically slowed down, and the trade surplus hit a record level. The investment sector is nearly back to its pre-pandemic level thanks to government policies supporting the economy's recovery, but production and consumption are still slow as a result of the pandemic's resurgence. Short of production slowed as supply chain problems brought on by the widespread reproliferation of COVID-19 in important cities like Shanghai, Guangzhou, and Zhengzhou spread to allied businesses. Consumption remained sluggish despite state support to encourage it, such as consumption coupons and subsidies, as a result of recurrent severe quarantine measures like regional blockades. In terms of investment, infrastructure investment significantly increased while manufacturing investment continued to exhibit a positive trend focused on high-tech production. The laziness became more pronounced. After October, exports started to decline year over year as demand from Europe and the US slowed down significantly in the second half of the year. Meanwhile, production and logistics disruptions persisted as a result of strict quarantine measures like the lockdown in Shenzhen and Shanghai in March. The employment sector employment indices like the unemployment rate and the number of newly employed persons declined as the shock brought on by the resurgence of COVID-19 and tightened quarantine measures spread across the economy, affecting production, consumption, and investment. While the nationwide survey's unemployment rate is increasing, 5.1% in December 21 compared to 5.7% in November 22. The unemployment rate in 31 cities, 5.1 to 6.7%, increased even more quickly as COVID-19 expanded widely, focusing on larger cities. 17.1% in November 22 remained high as well. Between January and November, there were 11.45 million new jobs created in cities, down from 12.07 million during the same time prior year. Consumer prices rose by 0.9% in 21 and 2.0% from 22.1 to November 2021, with food costs rising by 1.4% to 2.6% as a result of increases in the price of pork, whereas the increase in producer prices was restrained mostly by supply assurance and price stability measures, a decrease in demand as a result of the economic downturn, etc. Housing prices intensified, especially in small and medium-sized cities, due to weakening investor sentiment following the deterioration of the real estate market. Finance, foreign exchange market. In November 2022, the M2 growth rate was 12.4% as financial market liquidity increased as a result of the reserve requirement ratio's downward adjustment and the policy interest rates lowering. Due to factors like the expansion of RMB loans and the decline in non-bank financial intermediation, the growth rate of total social loans increased to 10.8%, June, and was reported at 10% in November. Stock prices have decreased compared to the start of the year. Long-term market interest rates have increased due to the U.S. Federal Reserve's accelerated policy rate hikes, and the exchange rate has lately decreased due to the relaxation of quarantine restrictions. The U.S. Federal Reserve's acceleration of policy rate hikes, among other factors, caused an increase in interest rates of 15 to 20 basis points from the beginning of the year, 3 10-year Treasury bonds. Despite the government's economic stimulus programs and the People's Bank of China's policy rate reduction, stock prices decreased 6.3% from the start of the year as investor sentiment decreased as a result of the lockdowns implemented in major cities like Shanghai, Guangzhou, and Beijing in response to COVID-19's reproliferation. Beijing Index. The Shanghai embargo and the U.S. Federal Reserve's accelerated policy rate hike caused the exchange rate to show strong weakness, rising, although the loss was curbed by optimism that COVID-19 quarantine restrictions would be loosened. This time, we learned about China's latest economic position. China's economy has suffered as a result of the COVID-19 outbreak, but now that it is easing significantly, I believe we may look forward to future growth. The following time, we will look at China's economic prospects for 2023.